I need to walk you through something that's been setting up for weeks, and it all converges in a 6-day window. I'm not talking about hype. I'm not talking about guaranteed moves. I'm talking about a concentration of catalysts, technical setups, and fundamental events that are all hitting the silver market in the same narrow time frame. And when you stack this many variables on top of each other, something breaks. Either the price moves significantly, or one of the narratives gets invalidated and we get clarity. Either way, this window matters. Here's what's lining up. Federal Reserve minutes dropping midweek. Critical employment data releasing at the end of the week. Chinese markets reopening after a holiday period that's kept massive physical demand on the sidelines. And COMEX delivery notices hitting a critical phase where we find out if March delivery demand is real or if it's going to roll quietly. All of this between late February and the first day of March. 6 days. That's the window, right now as I'm putting this together. Comment when you're watching this, because if you're seeing this in real time during that window, you can track the catalysts as they hit. If you're watching after, you'll see how it played out and whether the setup delivered. And quick, if you value breakdowns that map specific catalysts to specific time windows instead of vague bullish talk, subscribe and comment FinTalk OG so I know you're here for precision. Now, before I lay out the catalysts, let me frame how I'm thinking about this. This is not a prediction. This is a convergence analysis. When multiple independent catalysts align in a tight time frame, volatility increases. The direction of the move depends on how those catalysts resolve. But the probability of a significant move, up or down, goes way up. And that creates opportunity if you're positioned correctly and you know what to watch. So I'm going to walk through each catalyst, explain why it matters, show you the exact data releases and dates, and give you the price levels and signals to track in real time. Here's the structure. First, the 4 major catalysts and why each one individually could move silver. Second, the technical setup heading into the window and what the charts are telling us about support, resistance, and breakout levels. Third, the 3 scenarios for how this resolves: bullish, bearish, and sideways, and what each one looks like in terms of price action and follow through. Let's get into it. Catalyst 1, Federal Reserve minutes. The FOMC minutes from the most recent Federal Reserve meeting are scheduled for release midweek during this window. These minutes provide detailed insight into the Fed's internal debate about interest rates, inflation, and monetary policy. Why does this matter for silver? Because silver is extremely sensitive to real interest rates and dollar strength. If the minutes show that the Fed is leaning more dovish, meaning they're considering rate cuts or pausing hikes sooner than expected, that's bullish for silver. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. A softer Fed stance also tends to weaken the dollar, which makes dollar-denominated commodities like silver more attractive to foreign buyers. Conversely, if the minutes show the Fed is still concerned about sticky inflation and they're signaling higher for longer on rates, that's bearish for silver in the short term. Stronger dollar, higher real yields, less incentive to hold metals. What I'm watching for specifically is language around inflation expectations, labor market assessments, and any discussion of the neutral rate. If the Fed is hinting that they think they're close to done tightening, that's a green light for precious metals. If they're still in hawkish mode, that's a headwind. Catalyst 2, employment data. The jobs report typically drops at the end of the week, and within this 6-day window, we're getting either the full employment report or key labor market indicators like jobless claims and continuing claims. This data matters because the Fed's policy decisions are heavily influenced by labor market strength. If jobs data comes in weaker than expected, meaning higher unemployment, lower job creation, rising claims, that increases the probability that the Fed will cut rates sooner. That's bullish for silver. Weak labor data also signals potential economic slowdown, which drives safe haven demand. If jobs data comes in stronger than expected, that gives the Fed more room to keep rates elevated, which is bearish for silver in the near term. But here's the nuance. If jobs are strong but inflation is falling, that's actually supportive for silver because it means the economy is resilient and the Fed can cut without triggering a recession. The worst case for silver is strong jobs with rising inflation, because that locks the Fed into a hawkish stance. What I'm watching is not just the headline number, but revisions to prior months, wage growth, and labor force participation. Those details tell you whether the job market is genuinely strong or if the headline number is masking weakness. Catalyst 3. China reopening after holiday period. Chinese markets close for extended holiday periods, and during those closures, physical silver demand from China goes dark. Dealers, refiners, industrial users, they all pause. When markets reopen, there's often a surge of catch-up buying, especially if prices move during the closure or if there's pent-up demand. Recent reports have indicated that physical silver demand in China has been strong heading into the closure. If that demand resurfaces aggressively when markets reopen, it puts upward pressure on physical premiums and spot prices. What I'm specifically watching is the Shanghai Gold and Silver Exchange premiums. If silver in Shanghai is trading at a significant premium to London or New York spot prices when markets reopen, that's a signal of physical tightness and strong demand. If premiums are flat or negative, meaning Shanghai silver is cheaper than Western markets, that's a sign demand is weak or there's plenty of supply. This is one of the most underappreciated catalysts because it's not a headline-driven event. You have to watch the data. But Chinese physical demand has been a major driver of the silver market for years, and any time there's a reopen after a closure, it's worth tracking closely. Catalyst 4. COMEX March delivery notices and inventory trends. We're in the middle of the March silver delivery period. As I covered in previous breakdowns, open interest is elevated, registered inventory is relatively tight, and delivery notices have been running above normal. Within this 6-day window, we'll see updated delivery data, warehouse stock reports, and whether delivery demand is accelerating or tapering off. If delivery notices surge and registered inventory continues to draw down, that's a bullish signal because it means physical demand is real and the paper market is under stress. If notices plateau and registered stabilizes or even increases because eligible is being warranted, that's neutral to bearish because it means the system is handling delivery demand without breaking. What I'm watching specifically is the pace of registered drawdowns. If we see 10 to 15 million ounces exit registered in a single week during this window, that's stress. If we see 2 to 5 million, that's normal. Also watching the spread between March and May contracts. If March starts trading at a premium to May, that's backwardation and a sign of immediate physical demand exceeding forward supply. If the spread stays in contango, that's calm. Now let's talk about the technical setup heading into this window. Silver is currently trading in a range, let's call it roughly $75 to $85 per ounce, depending on when you're watching this. That range has been in place for several weeks after the crash from 121 down to the 70s in late January. Within that range, there are key technical levels that matter. On the downside, support sits around $72 to $74. That level has been tested multiple times and held. If silver breaks below 72, the next support zone is around 65 to 68. That would signal a continuation of the downtrend and likely trigger stop losses and further selling. On the upside, resistance sits around $86 to $88. That's where previous rallies have stalled out. If silver breaks above 88 with conviction, meaning strong volume and follow through, the next target is 95 to 100. That would signal a resumption of the bull trend and likely attract momentum buyers and short covering. The middle of the range, where silver is likely trading as this window opens, is no man's land. It's choppy, it's indecisive, and it's where traders get chopped up trying to pick direction. Here's what the technical indicators are showing. The relative strength index is neutral, not overbought, not oversold. That means there's room to move in either direction without hitting extreme conditions. Moving averages are converged, meaning short-term and long-term averages are close together. That's a classic setup for a breakout, but it doesn't tell you which direction. Volume has been declining, which typically precedes a volatility expansion. And volatility indicators like Bollinger Bands are tightening, which is another sign that a big move is coming. So from a pure technical standpoint, silver is coiled. It's in a compression pattern. And when you add fundamental catalysts on top of technical compression, that's when you get explosive moves. The question is, which way? Let's map the three scenarios. Scenario 1, the bullish breakout. In this scenario, the catalysts align positively. Fed minutes show a dovish tilt. Jobs data comes in weaker than expected, or at least not strong enough to keep the Fed hawkish. Chinese markets reopen with strong physical demand and elevated premiums, and COMEX delivery data shows continued stress with registered inventory dropping and notices surging. In this scenario, silver breaks above 88, runs to 95, and potentially challenges 100 within days. Physical premiums spike. Sentiment flips bullish. And the narrative becomes, the bottom is in. The bull market is resuming, buy the breakout. If this scenario plays out, the trade is to buy the break above 88 and hold for a run to 95 to 100. You'd want to see volume confirm the breakout, meaning above average trading volume on the move higher. And you'd want to see follow through, meaning silver doesn't immediately reverse back below 88. If it breaks out and holds, that's your signal. Position accordingly. Don't chase if it's already at 95 and extended. Wait for a pullback to 90 or 92 and add there. Scenario 2, the bearish breakdown. In this scenario, the catalysts align negatively. Fed minutes show continued hawkishness or concerns about inflation. Jobs data comes in strong, giving the Fed cover to keep rates elevated. Chinese demand is weak or absent when markets reopen. And COMEX delivery demand fizzles, with open interest rolling smoothly and registered inventory stabilizing. In this scenario, silver breaks below 72, tests 68, and potentially drops to 65 or lower. Physical premiums compress, sentiment turns bearish, and the narrative becomes, the rally is over, we're going lower, the squeeze failed, time to sell. If this scenario plays out, the trade is to either stay in cash and wait for a better entry, or if you're short-term bearish, you could trade the downside through puts or inverse ETFs. But I wouldn't short silver aggressively unless you have tight stops, because even in a bearish scenario, silver can rip your face off on a short squeeze if delivery dynamics shift unexpectedly. If silver does break down, the level I'd watch for a reversal and potential buy is 65 to 68. That's where longer-term support sits and where value buyers might step in. Scenario 3, the sideways grind. This is the frustrating scenario, but also the most likely in my opinion. In this scenario, the catalysts are mixed. Fed is neutral, jobs data is in line with expectations, Chinese demand is moderate, and COMEX delivery is elevated but manageable. Silver chops between 75 and 85, fails to break out in either direction, and we get another few weeks of range-bound price action. In this scenario, there's no clear trade unless you're a range trader selling resistance and buying support. For most people, this means patience. Wait for a clearer signal. Don't force trades in a range. If we get the sideways grind, what I'd watch for is which side of the range breaks first when volatility does finally spike. If we chop for a week and then break above 88, that's a bullish resolution. If we chop and then break below 72, that's bearish. But until one of those levels breaks, there's no clear directional edge. Now let's talk about exact price levels and what to watch in real time. Here's your checklist for the 6-day window. Day 1. Watch for any pre-catalyst positioning. Often the market starts to move before the data drops based on leaks, rumors, or institutional positioning. If silver starts creeping higher or lower heading into the Fed minutes, that's a tell. Day 2 and 3, Fed minutes release. Watch the immediate reaction. If silver spikes or drops $2 to $3 within an hour of the release, that's your first signal. Read the minutes yourself if you can. Don't just trust the headlines. Look for the language around rates, inflation, and the neutral rate. Day 4, jobs data. This typically releases in the morning. If the data is a big beat or miss, silver will move fast. Watch the first 30 minutes after release. That's where the initial reaction happens. Then, watch for follow-through over the next few hours. If silver spikes on weak jobs data but then fades by midday, that's a failed breakout. If it spikes and holds, that's confirmation. Day 5 and 6, Chinese reopen and COMEX data. Chinese markets typically reopen overnight for U.S. traders. Check Shanghai premiums first thing in the morning. If premiums are 5 to 10% above London spot, that's strong demand. If they're flat or negative, demand is weak. COMEX data updates daily. Check registered inventory and delivery notices every morning. If you see a big one-day drop in registered, that's a red flag for the shorts and a green flag for longs. Here are the exact price levels. Break above 88, target 95, then 100. Stop loss on a long position would be 84. If it breaks 88 and then reverses below 84, the breakout failed. Break below 72, target 68, then 65. Stop loss on a short position would be 76. If it breaks 72 and then bounces back above 76, the breakdown failed. If silver stays between 75 and 85 for the entire window, no trade. Wait for the break. Here's what I'm personally watching. I'm not giving financial advice, but I'm telling you my framework. I'm watching the Fed minutes first, because that sets the tone for dollar and rates, which drive everything else. If the Fed is dovish, I'm biased bullish on silver. If hawkish, I'm cautious. Then I'm watching jobs data as confirmation or contradiction. If Fed is dovish but jobs are super strong, those signals conflict and I'd expect chop. If both are dovish, that's a strong bullish setup. On the physical side, I'm watching Shanghai premiums and COMEX registered daily. If both show tightness, that's the kicker that could push silver through resistance even if macro data is mixed. Let me also say this. If we get through this 6-day window and nothing happens, if silver just chops sideways and all the catalysts are duds, that's actually information too. It tells you the market is waiting for something bigger. Maybe it's waiting for April or May when the next Fed meeting happens. Maybe it's waiting for a geopolitical event. But when you set up a window with this many catalysts and nothing moves, it usually means the market is discounting those catalysts and looking further ahead. Here's the risk you need to understand. Catalyst-driven trading is high risk because you're trying to time short-term moves based on data releases and events that are inherently unpredictable. The data could surprise in ways you didn't expect. The market could react opposite to what logic says it should. Fed could be dovish, and silver could still drop because something else is driving flows. So if you're going to trade this window, use tight stops, size small, and be ready to be wrong. For longer-term holders, this window is more about information gathering than trading. You're watching to see if the bullish thesis is getting confirmed or if cracks are forming. If the window resolves bullishly, that's confirmation to stay long or add. If it resolves bearishly, that's a signal to either take profits, tighten stops, or reassess your thesis. Here's my final take. 6-day windows like this don't come around that often. Usually you get 1 or 2 major catalysts in a week. To have 4 significant catalysts all converging in the same narrow window is unusual, and that creates opportunity for those who are prepared and paying attention. The market is going to give us information. Whether that information is bullish, bearish, or neutral, we'll know by the end of the window. Your job is to watch, react, and adjust. Don't predict. Respond. Tell me in the comments, are you watching this window in real time? And if so, which catalyst do you think matters most? I want to see where people are focused, because that tells me where the crowd is positioned. And often, the catalyst that surprises is the one people aren't watching. If this breakdown gave you a framework to track the next 6 days with precision instead of just hoping silver goes up, subscribe and comment FinTalk OG. And share this with someone who trades silver or gold, because this kind of convergence setup applies to both metals. One last thing, this is analysis, not advice. Markets are unpredictable. Data can surprise. I could be completely wrong about the importance of this window. Use this as one input into your own decision-making process, not as a signal to blindly trade. Manage your risk, know your stops, and only trade with capital you can afford to lose. All right, stay sharp, watch the data, and I'll see you in the next one.